All right, guys, what's going on? Grab a pen and jot this down. Today, we're going to quickly talk about agentic brokerages. I think this is a pretty interesting aspect of the industry. I think the shift that is happening, particularly in public.com, Robinhood just announced their agentic system this morning, is that we're shifting from like the retail side of the industry, where they didn't have an edge case, 30, 40 years ago. It used to be very expensive to do trading. Commission-based trading, stock-based trading, particularly to buy equities, it'd be $15 to $20 to $50 to $100 per trade. And obviously, when Robinhood was announced or developed in like the early 2010s, the trading cost went down to zero. So everybody went down, Schwab, Fidelity, TD, Trade, etc., E-Trade. So I've watched this proliferation of new equity investors come into the industry. It's been amazing because as the cost went down, we onboarded millions of new investors. They're much younger, they're more active, they're more knowledgeable. Obviously, they're doing some riskier bets, which include options and shorting and everything else. But because these brokerage houses have figured out different ways to make money, not from the front end retail commission, but from trading flows and payment order flows, they figured out different business models. Now, what's interesting is that agentic brokerages have a different aspect to what was personally retail trading, or I should say brokerage, calling your broker, where you would have to physically call someone and say, hey, I'm going to do X, Y, and Z. I want to buy Microsoft. I want to buy Disney. I want to do this over the phone. There's some aspect that people aren't knowledgeable about investing in trading. They would offload that level of intelligence or workload to a financial advisor, wealth manager, investment manager, or asset manager, or maybe a stockbroker, and say, execute the trade for me. I'm buying $50,000 of X. I need it at these prices. And then they'd inadvertently say some type of limit order. The broker has to be intelligent enough to say, we shouldn't be paying more than 10% on the current market value price or wherever it's trading at over the last 30 days. Or now is not a good time to buy the full allocation. So if we have to buy $100,000 worth of shares, maybe we should buy $25,000 this week, $25,000 in 2 weeks, and then the next 50% over the next 6 months. That's like intelligence trading, right? Now, most retail investors do not have that level of sophistication because they just go out and just buy, or sell, and do some mix and match. They have no real knowledge of portfolio management, trading allocations, trading flows, and etc. So they're just they usually have less than $1 million portfolios. If you have, if you're a large trader and you have like $100 million portfolio, which is mostly investment funds, hedge funds, then, you're making these large trades for like $25+ million to buy, I don't know, Google or one of these major houses, like major businesses. Obviously, it's not that much in terms of, NVIDIA is a multi-trillion dollars. So you buy $100 million of shares. You could probably execute it nowadays because there's so much liquidity for very liquid stocks, especially if they're mega cap, large cap. But if you have smaller cap businesses and you buy, multi-million dollar positions, there's an actual order of how trades are executed over minutes, seconds, hours, days, weeks, and you also don't want to move the market. So that's why they have limit orders. They have different ways, the buy-sell orders. You want to place them in different form factors. Retail, even accredited, even financial advisors, they're just not in the market direct. They're doing other things throughout their day-to-day. Obviously, financial advisors do a lot more wealth management, wealth planning, and other things. And then the average retail investor has a day job, has a family, and all this other stuff. So they're not really paying attention to the markets. So even if you place a buy order to buy NVIDIA, Micron, Microsoft at whatever the market price is, you might save 1%, 2%, or you might overpay by 10%, or you might get sold out of a position at the wrong price. You just aren't on top of it. That archaic move of buy limit orders is really just like stop loss orders, or just from the 90s. The agentic form of this now is, I want to buy Microsoft at X, Y, and Z price, meaning I'm going to ladder in at $50, $65, $85. I'm going to dollar cost average over 6 months. You would do this over the phone. You would tell a broker, they'd write their notes down and say, okay, this is good. We'll put in $50,000 to $75,000 worth of your portfolio into this position. over a period of time, and then we'll update you with reporting when trades have been executed, etc. What's interesting is that you now have the ability to do this in your mobile app. So it's coming to market. I think I haven't tested it myself on public.com yet, but I've seen the feature sets, and on Robinhood it looks the same, where you could say I need to do X, Y, and Z. While you're simultaneously doing research on the phone, you're looking at the stock price, you're doing valuation analysis, maybe some people are doing technical analysis, you're reading the news, you're kind of figuring out, like, all right, this is the market news, this is what's happening with investors, the executive team has bought or sold this many shares, I want to put 5% of my portfolio into this. Maybe I want to buy NVIDIA and sell AMD because I own both positions in my portfolio, because earnings are happening in the next 20 to 30 days. I don't have time to do, follow the news, etc. But I do have time to execute the prompt right now. And in this moment, I want to do this trade. And you determine, as an intelligent automation system that can execute trades on my behalf, when is the best time to execute this strategy over the next 30 days. And it might be buying $500,000 of one stock, and it might be selling $100,000 out of another $500,000 position, over the next 2-3 weeks. And I could see this level of intelligence being used, for sure, but really only by the power users that are really excited, they're really active, they're really, they have a large portfolio, probably over 30 stocks, or they have extreme concentration, and they have a large dollar amount invested, and they don't want to pay attention to everything all the time. Usually you would have to have this level of intelligence on your money manager. And what's interesting is obviously money managers, their fees have been compressed over many years. So they're in a different position. You no longer have to go out, even if you're, $5, $10, $20 million net worth and you have a large portfolio at Morgan Stanley or Merrill Lynch, you no longer have to go to your money manager to have a request or have it ask and say, I need X, Y, and Z, and then produce this over time. Instead, you'll say, I need $2 million in my brokerage account. I'm going to execute the trades. I don't need your team to do it. I don't need your brokers to do it. I just need the accessibility to your app. Maybe I need an API or an MCP or something else that, connect to my agentic brokerage system. Maybe it's all through Robinhood because they're going the wealth management route. Maybe it's not. Maybe it's another app. But I could see the individuals getting tremendous power. The problem, I think, that's the 1%. That's the power user. The 99%, I don't think they knew how to use limit or stop loss orders, or they weren't using it regularly, or they didn't care, or they didn't know about dollar cost averaging, or they didn't know how to build a portfolio or manage a portfolio over a period of time. They didn't know the importance of, reallocations or changing your thesis or creating a new thesis or marking against an index. Maybe they just don't care, which is fine, because the reality is most mutual fund managers actually underperform the index. So there's a level of passive investing that produces tremendous market alpha, meaning it at least performs the market or better. So the average investor could just buy the S&P and outperform. But the small percentage, somewhere between 1 and 10%, would be interested in these products. The 90 to 99% that don't use these products or aren't even good investors, they're better off just not doing this stuff. Because they didn't do it before, they don't care now. But at least they have the tools. They won't cost much, if anything. It's probably free again. But it's really cool to see. I think it's pretty innovative. I think all the brokerage houses will have it in some form factor. I think Robinhood, again, will dominate this space because they have the largest customer base and they have the most scale, etc. So they'll do well. And it'll be pretty exciting to see how they pull this off. I think it's net positive for everybody. Maybe except the money managers, which they have to figure out different ways to generate either alpha or provide services and justify their fees. I think the fee structure is better designed in a performance-oriented fee structure versus an asset management fee structure, or even a flat fee structure. I think performance is the best way to go. So we'll see. I think the money markets are just shifting, and I still think that buying the S&P or a large index is probably still going to be the best bet for the average investor. But now you have the optionality to go into your app, do research, do fundamental and technical analysis, look at earnings, execute a trade based on context, based on your portfolio versus you doing an individual position, which I think is interesting. So the level of custom indexing that you'll have in your own basket of stocks. So agentic brokerage accounts will be the future, and we will definitely see more of them going forward.